was the counsel at Citibank for 10 years, so I know a little bit about the banking business. The way you make money is you borrow short and lend long. You borrow at a low rate and lend at a higher rate, and you keep the difference. You got fees and credit losses and lots of complications, but that's pretty much what the banking business has always been. Well, if interest rates are zero all across the yield curve, in other words, if you're borrowing close to zero, maybe 25 basis points, and you're lending close to zero, maybe 1% or less, how do you make money? The answer is you can't. You can make a little bit of money, you can leverage it a little bit, but you don't make enough money to cover your credit losses and your expenses and your overhead and fees and a lot of other costs associated with that. So the flatter the yield curve, here's a 10-year rate, here's a overnight rate. If it's like this, you can make all this money in between. You're taking risk in terms of timing, but you don't have to take a lot of credit risk. But if it's flat, you can't make any money. So he's dumping the banking shares because they can't make money. Why would you buy Barrick? Well, he obviously likes gold. That goes without saying. But Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be able to buy junior miners anywhere. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying the junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive, produce and take all that risk. They'll just wait until other people do, hit a good gold mine, prove it out, start mining, start producing, then they'll just buy that company and add it to their output. Yeah, I mean, and for that matter, a gold mining company is a leverage bet on gold just because of the economics. You have fixed costs and variable costs. Well, once you cover your fixed costs, and assuming you can control your variable costs, as the price of gold goes up, all that money goes straight to the bottom line. Initially, you got capital costs and leasing and geological surveys and all kinds of things. But once you get producing and you cover your fixed costs, a lot of the incremental price of gold goes to the bottom line. The stock market gives you a multiple of that. So the answer is, if gold's going to go up 5 times, which I expect it will, or more, a mining stock could go up 25 or 50 times just because of the economics of stocks versus gold. When I talk about bonds, I'm talking about the U.S. government securities, U.S. Treasury securities, or I might talk about Japanese government bonds, so-called bunds, which are German government benchmark bonds, et cetera. I'm not really talking about corporate bonds. We could, but the problem with corporate bonds, they have the economics of bonds, but they also have all the credit risk of stocks. And they're very idiosyncratic. There's probably some good corporate bonds out there, and there's some you wouldn't touch with a 10-foot pole because they're going to go bankrupt. So I'll keep away from the corporate sector. I'm familiar with it, but that's not my area of expertise. So I'm talking about bonds. I'm really talking about U.S. Treasuries, unless I, specify one of the major other global benchmark bond markets. But bond math is not as hard as some people make it sound. This easiest rule, a little counterintuitive, but when interest rates go down, the price of the bonds goes up. And when interest rates go up, the price of the bond goes down. And the reason for that is if you have a bond with a certain coupon and interest rates go up, a new buyer is going to want that new bond. So, hey, give me that higher coupon. Well, I got this other bond over here, it's got a lower coupon. We'll say, well, you have to sell that to me at a discount because I need to get comp for the fact that it doesn't have as high an interest rate. So simple as that. Interest rates up, prices down. Interest rate down, prices up. That's how the bond market works. But the point being, and just one more little quick piece of bond math. So how much, I said prices of bonds go up when interest rates go down, which is true. How much? Well, the answer is it's not constant. It varies depending on the level of interest rates, something called the DV01, the dollar value of 1 basis point. How much does my bond go up for every 1 basis point decline in yield? Well, so let's say I cut interest rates from 9% to 8 3/4. That's a 25 basis point cut. Let's say I cut interest rates from 25 basis points to 0. That's a 25 basis point cut. Those two 25 basis points do not produce the same gains. The second one produces a much larger capital gain because the DV01 is higher. So in other words, when you're at low rates, low levels of rates, every basis point decline in rates produces a bigger capital gain than if the same thing were happening at higher level of interest rates. Now, your original question, Robert, was, well, what about gold versus bonds? What's up there? To me, I don't have to resolve that debate because I would say have both. Of course I like gold and I recommend gold, but I recommend 10%. Some investors are higher, seasoned to taste. But the point is, if you have 10% in gold, you've got the other 90% of your portfolio. What are you going to do with that? Well, I would have a slice for 10-year treasury notes for the reasons we just discussed. I'd have cash. There's room for equities and alternatives and all that. But you can have bonds and gold side by side. And that may be an ideal portfolio. It's generally correct. So if bonds are competing with, if gold is competing with money markets, let's say, well, let's flip from bonds to money market because that's the most liquid form. Money market funds, bank CDs, short-term investments, etc. If gold is competing with these money market or substitutes of money market funds, and their rate is 0, and gold's yield is 0, then it's a fair fight. Now it's all about capital gains. Now, obviously, we already talked about in the last segment how you can make 10 times your money in capital gains on price of gold. But if you're comparing yield to yield, even assuming the price is going to be constant, it's a fair fight. If they're both at 0, then take a pick. When you're borrowing money for real estate, in effect, you're issuing bonds because somebody's taking the Kiyosaki note. He's the bondholder, but
I issue bonds.
Many years that you want to be in the real estate side of that. You want to be the borrower, not the investor.
That's correct.
The bond investor, right?
And so I'm ignorant when it came to bonds. That was a whole thing. But now Kim and I have a lot of gold and a lot of silver, just because we saved money in gold and silver. We just kept using debt to get rich.
Sure. Well, you kept issuing debt, but now we're talking about buying debt.
Correct.
Correct. And for the investor, for someone with money, absolutely have your gold and silver, but I'd have some treasury notes side by side. If you have a living memory of a U.S. depression, you are 90 years old. And my mother's 90, so she remembers it. We still talk about it, but you're 90 or older if you remember the depression. So very, very few people in that category. Most people have never lived through a depression. They don't know what it is. They assume must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. So, but people aren't. We're looking at intergenerational changes, and again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression, it all converged in 2020. But a lot of people don't know. The stock market reached a certain level in 1929. Do you know when it crashed 90%? Do you know when it regained the 1929 level, when it got back to the 1929 level? 1954. It took 25 years to get back to where it was in 1929. Peter has a definition of inflation that may work for him, but it doesn't work for the Federal Reserve, the European Central Bank, the United States Treasury, or anybody who's trying to figure things out. So I use consumer price inflation. I mean, just to be a little technical, the Fed uses something called personal consumption expenditure deflator year over year. That's a technical name, but it's basically just their personal core, by the way, core PC deflator year. It's just their personal definition of inflation. That's the one I use. It doesn't matter if I agree with it or not. If I'm trying to figure out the Fed and the markets, I better use the same tools the Fed is using, or else I'm going to miss it. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion. Nominal GDP is money supply times velocity. This is just the quantity theory of money. This is Milton Friedman's famous equation, which actually goes back to Irving Fisher in the 1920s. Well, they took the money supply to 7 trillion. Okay, what's 7 trillion times 0? It's zero. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity. That's the zero in my case. Velocity has been dropping since 1998. It didn't start in 2008. It didn't start in 2020. It's been dropping like a stone since 1998. And it's getting closer to zero.